hell is that?
It's a bear.
The supposed great bear market of 2016 has relentlessly trended in the wrong direction, as each hope that the bears clung to once more dissolved in another ramping higher of stock prices. The latest best hope being the Fed meeting that was meant to deliver bear market apocalypse, and most recently Yellen yelling that the Fed is in no hurry to raise US interest rates, that keeps catching market participants by surprise. This despite near 2 months ago we saw the Bank of Japan panic with negative interest rates, and then earlier this month the ECB also panicked with negative interest rates. Nevertheless, the stock market has dutifully climbed a wall of worry to its last close of Dow 17633, positive for the year and within 4% of its all-time high of 18,351. So as the bears are blaming the Fed for the failure for stocks to fall, and if it's not the Fed then it's the corporates for buying back their own stock, or that the markets are manipulated, all without understanding the fundamental fact that the market is the sum of all actions, and the only place where this can be seen to become manifest is in the price. Just as I stated in March 2009, right at the beginning of this stock's bull market. And remember, this is what I've been stating for the 7-year duration of this stock's bull market, so it's not something obvious with the benefit of hindsight, as several recently are stating, all after the fact, after stocks have been rising for many years, that it was all due to Fed market manipulation, but then add, must imminently end. Well, the Fed and the rest have been manipulating stocks since at least October 1987, the day after the crash when the Dow bounced. And a reminder that my consistent view for the duration of this year, even in the depths of January's severe correction, was that the stock market would resolve with a trend towards new all-time highs this year, based on my in-depth crude oil price analysis of mid-January, concluding in the following 2 points, with my earlier stock market expectations directly based on my crude oil price analysis of mid-January 2016. The overall picture being painted by this analysis is expectations for 3 trading ranges that would act to step the crude oil price higher during 2016. For instance, the current bottoming range followed by a second retesting range and then the third breakout range. Therefore, my forecast conclusion is for the crude oil price to trade within 3 distinct trading ranges for 2016 of $20 to $40, $35 to $50, and $62 to $40. Furthermore, the trend pattern imposed onto the trading ranges implies that a bottom is likely by early February 2016 at around $25, followed by a trend higher into mid-year towards $50, correction into September, and then followed by a trend towards $62 before succumbing to a correction during December to target an end-year price of approximately $48 as illustrated by the graph. The bottom line is that the current oil price collapse is a wake-up call to all major oil producers that crude oil as an energy source is running out of time. So whilst there may be future oil price spikes, however the long-term trend given the likes of climate change is for the oil age to go the same way as the previous ages, such as the Stone Age and the Bronze Age and the Iron Age. So it will be for the oil age, which means nations such as Saudi Arabia, regardless of price, understand that they need to get as much as their oil out of the ground as possible and sold off before they run out of customers. And so, with the bears scurrying further back into their caves, given the relentless nature of the Dow's ongoing climb higher, here's my technical take on what is probably going to happen next, starting with the crude oil price that last close of 38.49, which stands $12 higher than its multi-year bear market low of $1.26 and near $4 below its recent high of $42. Clearly the oil price is undergoing a correction. However, the fundamental picture is one of strength, i.e. the earlier break above $34 that the oil price is now gravitating towards would allow the oil price to put in a significantly higher bottom. So in terms of my crude oil price forecast, nothing much has really changed. The oil price remains on target for a doubling off of its low price of $26 and therefore a trend towards at least $52 before the end of this year. The implications for stocks are that if it continues to track the oil price, then stocks too would be expected to undergo a similar correction that they are currently showing relative strength against. Whilst the UK FTSE Stocks Index is clearly showing relative weakness to the Dow after having failed to participate in the most recent rally to new highs, with the MACD also rolling over. So along with the crude oil, the Dow is showing divergence against the FTSE, which therefore implies to expect the Dow to revert towards a similar downwards trend. US economy and interest rates. The US economy is slowing fast as Fed or market 2016 prospects for 2.6% GDP have already dropped to 2.2% and will likely continue to move towards 1.5%, which is pretty similar to what I expect for the UK. Therefore, markets' expectations for 5 rate hikes for 2016 have already evaporated to just 2. So what's the odds that by the end of the year, instead of raising rates, the Fed could even cut rates and pump more QE or whatever they call it at the time into the weakening US economy to prevent a recession? After all, it is an election year. And here's a reminder of what I wrote over 6 months ago for the prospects for US interest rate hikes. The key here is uncertainty. Uncertain prospects for rates and economy tend to result in stock market weakness, which is supportive of the view for an imminent correction and the market then basically waiting for some easing from the Fed. Elliott wave analysis. The June 2015 high was clearly a fifth wave peak, with a subsequent price action to the February 2016 low most easily resolving to an ABC correction low pattern, which implies to expect a series of impulse waves higher to new all-time highs this year. However, imminently, wave 1 should juncture and resolve with a wave 2 correction to between Dow 16,800 and 16,250. And briefly, seasonal analysis. On average, stocks tend to fall about 4% in a year when the sitting president can no longer stand, though this only has 4 occurrences. Otherwise, the presidential year average is for a 7% gain. While seasonally, stocks tend to rally into early May and then fall into August, which is not far off from what happened last year. So this year we may see some inverse price action, i.e. a weak April. Trend analysis. The Dow clearly has support around 15,500 and resistance at 18,000. Most recent price action hit resistance from a downtrend line coming off the all-time high of 18,351. Therefore, the Dow has so far yet to test Dow 18K, which may be the immediate direction, whilst trend analysis suggests that the Dow will be targeting 16,500 before it sets itself up for another decisive attempt at breaking above Dow 18K. Whilst the MACD has reached levels last seen when the market was topping out in November 2015, therefore implying a significant correction is imminent. Therefore, my forecast conclusion is that whilst the Dow is yet to give a technical sell signal, i.e. still in rally mode, nevertheless component analysis is clearly converging towards imminent bearish expectations for the stock market. However, we would still be in a bull market, which implies that stocks are likely to undergo a correction to a range of between Dow 16,800 and as low as Dow 16,500 against the last close of 17,633 over the coming weeks, and ahead of the Fed or another major central bank announcing it's going to print money for election year 2016. Therefore, as the title of this video implies, the bears are going to be handed another noose to put around their necks, who I'm sure will reach their most vocal just as the stock market correction bottoms and snaps higher by probably late April. Whilst the alternative is that if this conclusion for a correction proves wrong, then the next most probable alternative direction will be for the Dow to blast off towards new all-time highs, which will likely also be accompanied by stronger oil prices. And ensure you are subscribed to this YouTube channel for my ongoing analysis and trend forecasts.
Echoes away.